Hi friends, I am CA Ushma Jain. Welcome back to my channel. If you are planning to buy a property from an NRI seller, this video is a must watch. We will be diving deep into the tax obligations and some key tips you need to keep in mind. Let's work together to make your dream purchase into seamless reality. In this video, I have covered all the points which a person should keep in mind while buying a property from a seller whose residential status is a non-resident. So we are going to cover these aspects in our video. Let's start with our first point, which is understanding TDS and tax compliance. First thing first, let's talk about TDS, that is tax deducted at source. One of the biggest differences when buying a property from a NRI versus a resident seller is the TDS rate. For resident sellers, TDS is only 1% of the property value, and that too if property value is above 50 lakhs. But for NRI sellers, it's a whole different ball game. You as the buyer are required to deduct TDS even if the property value is less than 50 lakh. And TDS rate starts at 12.5% and can go up depending on the sale value, including surcharges and cess. This deduction is on the entire sale consideration, not just the capital gain. For resident seller, you have to fill form 26QB, while in case of NRI seller, form 27Q needs to be filled. Our second topic is TAN requirement for buyers. Now, here's something many buyers overlook. You need a TAN, that is tax deduction and collection account number. This is mandatory when purchasing a property from an NRI seller, and it's different from a PAN. It is specifically required to report and deposit TDS. If you don't have TAN, you need to apply for it immediately, as it can take about 1 to 2 weeks to process. Please keep in mind, failure to deduct and deposit TDS correctly could result in hefty penalties, so make sure you have this sorted from the get-go. Third is payment protocols. Let's talk about payments. Any payments you make must go to the NRI seller's NRO, NRE or FCNR account. This is crucial to comply with the Foreign Exchange Management Act, that is FEMA. Depositing directly into their regular saving accounts is not advisable, as non-residents should not maintain regular saving accounts. Generally, deposits are done in NRI sellers' NRO accounts. Fourth point is power of attorney. If the NRI seller can't be physically present, they may appoint someone in India through a power of attorney, which we call POA. This POA must be notarized and attested by the Indian consulate in the seller's country. Even with a POA in place, the TDS must be deducted for NRI seller only, and that too as per NRI rates. Be vigilant and ensure all documents are in order before proceeding. Next point is co-ownership. If the property has co-owners, each owner's share should be clearly mentioned in the deed, and TDS should be deducted based on their respective ownership percentages and residential status. For example, if property is co-owned by NRI and resident seller, then you have to deduct TDS at respective rates applicable for NRIs and for resident seller. Next point is lower TDS deduction. Sometimes the NRI seller might request a lower TDS deduction. They can apply for a lower TDS deduction certificate from the Income Tax Department. If this happens, please cooperate with them by providing necessary documents like your TAN, initial sale agreement and payment receipts. However, make sure this certificate is verified before adjusting the TDS rate to avoid future disputes with the tax authorities. Next point is documents verification and due diligence. Documentation is a key in any property transaction, but even more so when dealing with an NRI seller. Few points which you should check are verifying the title deed to ensure clear ownership, checking for any existing loans on the property, ensure the seller's PAN cards is valid and active, and confirming that there are no pending taxes or legal issues tied to the property. Next point is penalties for non-compliance. Remember, any non-compliance like failing to deduct or deposit TDS can have serious consequences. Penalties include interest of 1% per month on the amount not deducted, a penalty equivalent to the TDS amount if not deposited, plus late fees for filing late TDS return. Next point is filing income tax returns. It is advisable to file your income tax return even if your income is below exemption limit. Many buyers are getting notices for the purchase they have done few years back if department doesn't know the source of funds. Basically, your income source should justify the sale consideration. Next point is documents for future records. Keep all documents on record, including the sale deed, purchase agreement from the sellers, loan allotment and disbursement details, payment receipts, bank statements, etc. for future reference. To avoid these pitfalls, be diligent with documentation and consult a professional if needed. That's all for today's video. I hope you will find this information helpful. Leave your questions in the comments and I'll be happy to help. You can reach out to me directly. These are my contact details. Thanks for watching my video. See you in my next video. Thanks.